There
You
we
see
go.
the start. Yep.
Get started. Okay, I think we're here. It's noon Eastern time. So good afternoon, everybody, or good morning, depending on where you are. We got people who are all over the country today watching this. So really excited. Happy New Year to those I may not have spoken to. Really excited about this one. We got a lot of buzz on this. In fact, there's going to have to be a part two to this already, just from new things that are happening. And Sherise, who I'm about to introduce in a few minutes, her presentation was about 50 slides when we first started. It's that much information. But really excited to have all of you here today. For those who um, have been a part of this series is here to really educate and help everybody involved. We want to make sure we're adding value to everyone that we touch and that you can also do the same. Um, and so this is the 2026 tax update, the age of the big, beautiful bill. Um, this is so politicized, and some people are very happy, some people are very upset about what's happening. But even if you're upset, you can't allow um, for yourself not to participate in all the wonderful things that are available here and that you can take advantage of. And so I'm Glen Wright. My partner is Sherise Jones, managing partner of Worth Advisors. She's going to go through this presentation today. Let me give you a little background about Sherise. So if you've ever, this is a rhetorical question, but how do you know if a CPA is good or not? Right? You don't know until you actually try them. So Sherise and I go back over a decade, quite close to 15 years now. But when I first moved to Charlotte, I didn't know who was a good CPA. And so for me, this was very important because I understand the power of tax savings. Um, and so I had 8 different accountants prepare CPAs, prepare my taxes. And Sherise has heard this story a million times, and I'm so grateful for her. She was the one that saved me $33,746 more than anybody else out of the other ones. And some of them were part of bigger firms and so forth. So I thought that they would do it. But Sherise was amazing. And then also, with working with her, she helped me to understand the ins and outs of profit and loss statements and balance sheets and all those things to really look at what I found to be a passion, what I care about in this business, to actually run it like a business. So um, she's going to be going through some great strategies for all of us to hear today. And let's go to the next slide and just get into it and talk about why this is so important. In wealth management, there are different components, and we talk a little bit about all of them. If you were part of some of our earlier sessions in previous months, we focused on estate planning, making sure that once you pass away, that your wealth goes to where you want it to go. If you can't take care of yourself, that you still have control over your assets. Cash flow management, retirement planning, risk management, which includes insurance, um, investment planning, and tax planning. They all go together. And so during these monthly webinars, we're going to give you the blueprint of what you're going to need to be successful. If you follow these things, you're going to be successful. It's as simple as that. These are tried, true, and proven. And so we want to make sure you get the information. And so tax planning is so important for a reason. Typically, when people think of wealth management, they think of, oh, and I say I'm a wealth manager. They say, oh, you invest money. That's what they're thinking, like other firms. But that's just a small portion of it. And so if I told everyone that they could receive a 10% annual return, they'd probably be pretty happy, right, to get a double-digit return. But that's only the beginning of the process because it's not about what you make, it's about what you keep. And so if you're in the higher tax brackets, let's say 37, 40%, if you include state tax brackets, you make 10%, but you're paying tax on all of that as ordinary income. Now you're down, instead of making 10%, you only made 6%. And then you look at that difference, that delta, over a period of 5, 10, 20 years, you're probably talking about millions of dollars that have been squandered because proper planning really wasn't put in place. So tax planning is going to be important in every facet. So that's why we really want to focus on this. And so without further ado, I'm going to give it to Sherise. Thank you.
Thank you, Glenn. Thank you for that great introduction too.
Just
We
telling the
are
truth.
going we are going to get started on this. And just to warn you, we're doing a very high level um, snapshot of the deductions and just tax reforms out there, because there is a lot out there, and we're trying to dig through. Of course, this bill is really extensive, but just to get started, what is OBBB? Well, in a nutshell, it's a comprehensive tax reform law designed to stimulate economic growth by lowering taxes, boosting business investments, and providing planning incentives for individuals as well as businesses. And you'll hear a lot of uh, discussions on tax planning. And I believe this presentation will help you understand a little bit about how important it is for tax planning, especially for this year. The first one that we're going to start off with, and the way that this webinar is going to go is that we're going to start off with small businesses, small business owners, right off the jump, because that's where the majority of these deductions are helping small businesses as well as large businesses. But for those businesses that are looking for ways to help lower their tax liability. And the first one that we have is the qualified business income deduction, QBI. And I'm sure you've seen this in the past, where you're taking you're able to deduct up to 20% of your qualified business income, where you're reducing the taxable income without reducing your cash flow. For example, if you had like $100,000 of net income coming in, well, 20% of that is 20,000. You're only being taxed at 80,000. So you still have the 100,000 coming in. That's part of your cash flow, but you're only being taxed at 80,000. Now, of course, there's several different limitations and thresholds and different avenues that you have to go through in order to really appreciate this deduction. Now, for 25, it was supposed to end last month, in fact, but because of the OBBB, this deduction has now become a permanent extension. And this is what I believe will help most of business owners, especially those that are pass-through entities and for the sole proprietor businesses, where you can actually plan now how you can use your funds if you know that you have the opportunity to be able to save 20% of your business income.
So, Cherie,
Now,
I got a quick question
yes.
for you. So,
Mm-hmm.
if someone has, one, make a quick comment. Anyone else have any questions? Put them in the chat. We have a portion of the this conversation at the end where we'll look to answer your questions. So, but just to be clear, so if a single person makes $300,000 a year, then part of what you were talking about for tax planning would be to get them below the phase out threshold so that they
Yes.
might be able to save the 20% on top of that. Is that what you're saying?
Yes, you have to be within the phase out um, section there. Now the threshold is it starts at for 26 201,750, but then it phases out if your income is over this 276,750 number. So you want to make sure that you keep within those guidelines. But if you do that, the fact is that if you have a like an S corp or a partnership income coming in, you'll be able to save up to 20%. And I say up to because there's always some limitations and other um, items that you have to consider. One of the other things that I've been researching is that 20% may increase going forward. It's right now um, in in Congress as far as whether or not if it's going to stay at 20% or go even higher. So I think this is one of the best deductions for if you are an S corp partnership or a sole proprietor or Schedule C filer for your business. Of course, there are some other, I guess, other tax owners that may not be able to take partake in it, so to speak. If this phase out is over the amount, I know for us, accounting, consulting, and financial services, we definitely have to be careful that we don't go over that amount. Otherwise, you wouldn't be able to benefit from it. The next one that we have is the if you have a C corporation. And the C corporation has where you can, first of all, the C corporation's tax rate has been lowered to that 21%. So right now it's sitting at a flat 21%. Um, and it's going to continue to be that way. There's no changes as of yet if it's going to increase or decrease. But right now it's at 20%. But what I found out was the fact that um, most times C corp has the double taxation where you're being taxed at the corporate level and then again at the shareholder level. Well, they have where you can retain some of those earnings and keep them in the business instead of having that second layer until you get ready to prepare distributions. So you could use some of those earnings for avenues of purchasing equipment or technology, or if you're expanding, or even hiring more employees, which I think is very impressive to have because most of the time, with the double taxation, you're having to dealt out the dividends instead of being able to reinvest. So under this act, you're able to reinvest within the corporation, which can be more tax efficient than just paying out dividends.
So if you have $100,000 and normally in a pass through, then you have to pay tax on that 100,000, even if you decide the next year to put the money back in the business. But
Right.
this
This is for
way,
C corporations. These are for
but
C corporations.
right.
Yeah.
And so if you have a LLC that may be a S corp or a sole proprietorship, But but so what you're saying is for that same 100,000, if I know I'm going to put it back in the business, then it could make sense if this is going to be continuous to maybe look at a C corp. So now I don't have to pay tax on the business and then put it back in. I can retain some of those earnings.
Yes.
That's that's
Yeah.
pretty awesome. Okay.
Yeah. And this is part of that economic growth and also expanding on business investments that the that that the OBBB is trying to perform here, to stimulate more economic growth. And this is one way of doing that, especially for C corporations. So I thought that was very unique, and especially if you're thinking about moving to a C corporation instead of a partnership or an S corp. R&D and innovation benefits. Basically, if you have a business where you are performing research, developing applications, or preparing, or software process, this here is a definite, whoops, is a definite benefit that needs to be looked at. Under the OBBB, businesses benefit from the favorable R&D treatment by accelerating the deduction and preserving the credits. Okay? What that means is that you're able to take the deduction, the expense, and also take credits on that as well. And I
Mm.
think that's very important if this is something that if your business is looking to get into.
Can you give a, this is powerful. Can you give
Yes.
a example of what a R&D expenditure might look like for someone that may have a some business, some small
Okay.
business?
Well, let's say you're developing an app or application, software application. Under the federal guidelines, of course, there's guidelines on exactly what that looks like as well. You can use part of your salaries that you may have. If someone on your team has dedicated their time on working on that particular project, you can also look at um, other tax. I want to say tax. Other software expenses also to be considered to be part of the research and development. You could be able to
Mm.
expense that as a business expense and also be able to apply those expenses to the credits as well. In
So if I
fact,
so let me
go
ask
on.
you, so
Uh-huh.
if I have a consulting firm and I am working on my own proprietary way of consulting, and I go
Yes.
hire other people and I'm doing research and I'm getting software and keeping all that. So all of that extra cost for this could be considered research and development that I could not only deduct, but also get a credit on top of that.
Yes.
Okay.
Yes.
All right.
I had to check that out again
Yeah.
myself because I
Yeah.
was like, oh, that's
Yeah.
different compared to the way that it was how R&D credits were done in the past. In fact, under the OBB, if you have been under R&D research for maybe several years, They have where you could go back to tax year 2022 and be able to go back and amend the tax return to include any unused tax credits and or expenses as well.
You know,
Now, I
I remember you told me about that, and we get people to call us all the time about tax advice, and they're calling you
yeah,
primarily. And what I've noticed is no one that they were working with previously or currently are telling them this, hey, we're going to go back and amend your taxes because you have these opportunities that didn't exist years before. I think that's amazing.
yeah, yeah, especially going back to 22, because usually you're only allowed to go back, 3 years or so. And, this particular, because you can go back to 2022, you would have to have that paperwork all in before, if it's a S corp or a partnership, have it in before March 15th, and if it's a C corporation, have it in by April 15th. Those are the deadlines for 2022, specifically. But the fact that you can go back that far and be able to make those corrections is phenomenal. And that's one of those benefits that it, it doesn't get um, enough advertisement, basically,
Yeah, we're not
because
getting the press. Everyone
yeah,
doesn't know how to do this and use R&D credits, so
yeah,
don't want
I
to talk
think that
about it.
that's one of those things that you really have to know and follow. This is all under the federal guidelines, but you definitely would have to follow all of these different tax laws in order for this to qualify. But once you go through that motion and you get it set up, these are just different avenues to be able to help lower your tax liability. And that's basically, in the end, is what we want to do.
Okay.
So I'm just really excited about that because we have, few clients that are looking into that. So,
Yep. No, it's
um,
exciting.
now here are some deductions that you need to watch out for. And I feel like the excess business loss limitation, that one stands out a lot more than it used to. And basically, what that is that it's a limitation on how much loss that you can deduct against non-business income. Anything that's beyond that limitation, it becomes treated as a net operating loss, and then you have to carry it forward. So, to give you an example of this, and this is so important,
Mhm.
for 2025, the threshold for a single filer is 313,000, and for a joint filer, it's basically double that amount, 626,000. If you have a business where you have a large amount of losses, and let's just say we use the single filer for example.
Mhm.
Let's say, for just for round numbers purposes, the limitation is 300,000. You may have a loss of 500,000, and you won't be able to use all of that. You would only be able to use up to that amount, and then the rest would have to be um, treated as a net operating loss, and then be carried forward until future years.
So let me ask you, I like
Mhm.
round numbers. So
Yeah.
let's say the person has a W-2 income of $500,000. The
Mhm.
business loses $1 million and they're a single filer.
Oh, oh,
So they can't deduct the full million, is what you're
no.
saying, off the 500,000, but they can deduct up to that limit of 200 something thousand.
Yeah, for 25, it's 313,000.
Okay, so they
Now,
can deduct 313,000
for 25,
for
that's for
25.
this tax period. And the reason why I bring this up is because for 26, it decreases by $57,000. So for
Mhm.
26, instead of it being 313,000, it decreases to 256,000.
Oh, wow.
Yeah. So if you had someone, let's say it's let's, for round number purposes, 250,000, and you have losses of 500,000. In the past, you would use your let's say the 300, you'll be able to at least have 57,000 more to be able to deduct. Because of the fact that this decreases the amount, that means that more is going to be added to the net operating loss to be carried forward. That means that less will be able to use as a deduction. And this is where the planning comes into play. Because if you do have any income that you can add into that year, that helps alleviate some of that um, access. Or if there's any expenses that you can wait until the next year to incur, that also helps as well.
Mm.
So it's been an eye opening. I mean, it's been around for a little bit now, not too long, but the fact is that I'm starting to see that more and more with businesses having larger losses and not being able to take all of that loss during that particular tax year.
Okay.
The other deduction to watch out for is the interest expense. There's limitations on that as well. It's still at 30% of the adjusted taxable income, but now it excludes the depreciation and amortization of it all. And the limitation applies before the elected interest capitalization. And what does that mean? It means that the interest expense limitation is calculated before a business chooses to capitalize the interest, in an asset.
So again,
So
so more than likely they're just going to be able. It's going to be a smaller interest amount, a smaller deduction.
yes, yes, it's going to be smaller. Um, right now it's at 30%, but it's the way that they're capitalizing it based on your financials.
Okay.
Yeah. And then which
I'm,
this one here, meals and entertainment.
I'm sad on this one. This is
I,
bothering me. I like my
I
snacks.
think our staff will probably be sad on this one too. The fact that meals, um, they're limiting the deduction for meals and food provided for employees for convenience purposes, meaning free lunches and snacks. Um, I know in the past that the entertainment part of it is definitely um, been limited, but now they're limiting meals that they feel that's like 100% deductible, and I believe that's probably why um, to cut back on that.
Okay.
So
That's sad, sad, sad. So
yeah,
the key is it's important to watch these things. So as you're looking for deductions, you can't keep doing the same old, same old. The tax laws change, and you've got to change how you maneuver where your deductions can come from. That's what this sounds like.
yeah. And again, if you plan it correctly, it won't be a surprise, at the end if you plan it during the course of the year. Of course, me, Glenn. I'm definitely going to be looking into that the meal part of it because see,
I like my snacks. Okay. Yeah.
yeah. So that these are deductions that you definitely need to be aware of that can creep up on you. If like for example, if you haven't had any issues with business losses before, and then all of a sudden you have this loss, and then you're wondering what's going on, it's important to make sure that during the year that you have that planning opportunity to make sure that you're not surprised in the end.
Okay.
So um, here we talk about cash flow and tax planning opportunities. In a nutshell, cash flow and tax planning strategies, it focuses on timing of income and expenses. It also helps choose the right entity structure and optimize the deductions to minimize taxes while maximizing available cash. So basically, what we're talking about is making sure that your tax planning strategies kind of goes along with how your structure is is how you choose your structure, and also the timing of how you look at different deductions, whether or not should we take, at the end of the year, should we purchase more equipment? Should we purchase that company car, or should we wait? Based on these other from the prior slides, where if there's a limitation on the business losses, or does the QBI help lower the tax liability to be able to bring on additional income, or be able to take more expenses on as well.
So
So
I got a question for you, Sherise,
uh-huh.
on this one. This is another powerful one. One,
Yes.
especially when you look at S corps and the benefit of that. People think
Uh-huh.
about, and normally the questions I'm receiving are about taxes or just pure income taxes. But we don't, as when you hear about business owners who receive money through pass-through entities,
Yes.
self-employment tax is typically not talked about, but it's a pretty big number, and can be, and people are surprised when they come to you on how that number can be reduced dramatically. Can you speak to that for a few minutes?
Oh, sure. Yes. Usually, when folks set up a business, the first thing that they do is that they set up an LLC. But um, what they need to understand is, by setting up this LLC, the structure of it can go in different ways, different avenues. So the LLC defaults naturally as a Schedule C for a single member, or as a partnership if you have two or more folks. The self-employment tax is a is an issue because of the fact that as a Schedule C, you're paying your regular taxes, at the regular federal rate, but you also have to pay your self-employment tax, which is on a different line item um, when you're calculating your taxable liability. And you will have folks that may have $100,000 on a Schedule C showing a net profit, and not realizing that 15 point, what is it, 6% of that has to go for self-employment tax. And you also have to pay taxes on your regular federal taxes as well based on your tax rate.
So
By
you're saying 30, so if I'm at the 30% tax rate, then I'm at the 5% state tax rate.
yes,
So that's 35. And then you're saying another 15% tax. So I could be paying over 50% taxes if I don't watch what I'm doing.
right. And this
Wow.
is where making sure that you choose the right entity to help lower that tax liability. And one of those is conforming into an S corp. You'll always be an LLC. It's just that you'll be taxed differently as an S corp to help. Now you're not getting rid of the self-employment tax altogether, but what you're doing is lowering that liability just based on salaries and not on your total bottom line, and that makes a big difference on that.
Okay. Thank you.
Yep.
And Sherise, we've got about 9 minutes left to go
Okay.
through this, and because we got a lot of questions that we
Yeah.
want to save time to go through.
Okay. Moving right along to real estate investors. There's a lot of different, and I mean, this particular topic can have its own hour in itself, but the main focus is the enhancement on the bonus depreciation and the cost segregation benefits um, that plays a part of it. Now that it's under the OBBB, the bonus depreciation is now a permanent um, deduction. So it helps be able to accelerate depreciation opportunities. And this is not just for real estate investors, but for any business that has equipment or other accelerated type depreciation expenses. I think that's so important that we have that opportunity now that we can uh, take, for example, I know this is one of your favorites too. If you have a business car, you're able to take the full amount of the value of the car if it's over 6,000 pounds. Most
Gross
likely, it's
weight,
like a
gross weight, 6,000
gross
gross weight,
weight.
not curb weight, 6,000 pounds.
Yeah, where you can actually take the full amount of it. That's one of the better opportunities to be able to take that deduction to help lower your tax liability, as well as if you have equipment or furniture or other improvements, even that also falls under that category for bonus depreciation. For realtors, it also helps. Another part is the qualifying business income deduction. For certain rental activities, you'll be able to take the QBI deduction as well at the level of it being a trade or business, meaning that you have to go through the IRS level of the hours and what you have to do in order for that to happen, to be a real estate profession. So I thought that was very interesting for that. And just to go quickly into the personal, here is the standard deductions for 26. The rates have increased. So that at the 37% for a single, it has now increased to 640,600. And if you're married filing jointly, it's 768,700. So
So
it
the
went
rate
up.
the rates haven't increased, but the amount of income has gone up.
Yes, the
Okay.
amount of income.
So people
So
should be paying a little bit less, right? That's the
yes,
okay.
yes, because whatever they're making that will probably be in maybe a different bracket than it was the year before. So one of the things that is going to be new, unfortunately, this is only from 25 through 28 tax years. Seniors will be able to take an additional $6,000 um, that can be added to their deduction. So for 25, a senior will have a deduction level of 23,750, and married filing jointly 46,700, and then
Mm.
that jumps up for 26, 24,150 and 48,100. I think that's very important for seniors when they're, at that point where you're trying to definitely plan to make sure that your tax liabilities are not out of whack on that. But I think that $6,000 does help lower that tax liability.
No, this one is great because we have clients who retire and their taxes become more complicated. People think that Social Security is tax free, and that's not the
It's not.
case,
It's
right?
not.
So it's based on where you are, your tax rate. It could be as high as
Hmm.
85%. Um, and then
Yeah.
you have pension and maybe some other money, interest, all this other
Hmm.
all these 1099s coming in, and you end up paying more in taxes. So this is helpful. I know
Yeah.
my mom's
Now
a
it does phase out at 75,000 for single and 150 for married filing jointly. So there's
so it
always
matters.
something.
So tax planning, again, even for
Yes.
someone who's retired, tax planning
Yes.
still matters to make sure you're under these thresholds if you have a way of doing that.
Yes.
Wow.
Definitely. Yep. And here are some other personal deductions, which is new. The car loan interest, and this is temporary from 25 to 28 tax years. But if you purchase a new car, and I mean a new car, like right off the lot, you're allowed to take up to $10,000 in interest. Leases do not qualify for this. And it is a above line deduction, meaning that you can take this deduction even if you take the standard deduction. Okay. It cannot be, this has to be used for personal use only. It cannot be used for business. And there are some thresholds here for single filers. Your income has to be less than 100,000. Married filing jointly, less than the 200,000. And then the other deduction, which I know a lot of people will be happy, the SALT deduction has increased. 40,000 for 25 for this tax period, and then for 26 it goes up an additional 400. And now this stays until 2029. It starts to phase out once your income is over 505,000, and it totally phases out. I think it's like 600,000.
Mm.
Um, but this here affects a lot of people. And in case anyone didn't know what SALT means, it means state and local taxes, meaning your real estate taxes, your local taxes, your state withholding taxes, all of that. The cap has gone from 10,000 now to 40,000.
Yep, that is substantial.
Yes. So,
Okay.
and I believe we are in the Q&A session now.
Okay. Wow, that was incredible. And because of that, you're receiving a lot of questions. So let me start
Okay.
with question number one. Um, who's considered a senior? So you talked about the senior deduction. Can somebody 45
No, I
take
believe
that?
it's you have to be over the 65.
65. Okay.
Yes.
Okay. Um, so I think the person asking might be 45, so that's why okay. Um, At what stage do you look, how much money should you make to start an S corp? I think what the question is saying is how much income should you be bringing in before you start looking at having an S
Yeah.
corp?
Well, there is no magic number. However, I usually advise if your net profit is more than 40,000 is when you really should start to look at, different opportunities as far as like changing over to the S corp at that point. Um, I will say this, when you decide to make that jump from a single member LLC being taxed as a Schedule C to being taxed as an S corp, it is a standalone um, entity. You are able to uh, take more benefits as an S corp filer, but it is a separate entity, meaning that a separate tax return will also have to be filed as well. So there are some additional expenses from making that jump to an S corp, and you would have to remain in S corp for at least 5 years. If you decide in year three you don't want to do it anymore, you don't want to be filing as an S corp, well, you would have to untangle the last 3 years of being an S corp, and that can be really, really messy.
Okay. Um, so what you're saying is that this is going to go to an S corp. If they work with you, it's going to cost more to have an S corp, right? Because
Yes,
it's a higher price, it's a different preparation. Okay.
yes,
But it
because you're
has to
not
make
just
sense financially.
yeah, because you're not just preparing the 1040, you're also preparing the 1120S form as well.
Yeah.
And there's franchise taxes at the state level as well that you have to consider.
This is an area that I think is so important when you're looking to build your group of advisors. Um, normally when I'm going into Home Depot, I'm gonna look and see if I have a coupon, if I can save as much money as I can to get the lowest cost for what I need.
Hmm.
When it comes to tax planning and tax services, sometimes I see that with some, but most business owners get it. You are not going to be the cheapest to work with, which we'll talk about in a second. But if I'm looking at this, if I pay, let's say I'm paying H&R Block $200, but I'm paying $100,000 in taxes compared to I'm paying you 5 times that or whatever, 10 times that. But now I'm paying, so let's say I pay you $10,000 instead of $200. But now I'm only
It's a big jump.
paying, but well, yeah, I like to use extremes. So, but now instead of 100,000, I'm paying 50,000. Would I pay 10,000 to save 50? It makes sense to me.
Yeah.
So, I think it's just so important to have, and then there are other things that it's like the S corp that you just brought up, for instance. It's a different
Hmm.
return that has to be filed. There's more work that needs to be done, different things that need to be set up. And I think it's important to look at that. Okay, let me
Yep.
keep going. Um, Next question. Um, do you work with residents only in North Carolina or all over?
All of 50 states.
Yeah, and you got some people in other countries too. So
Yes, that's true too. Yeah,
I,
Dubai
I'm gonna
and
brag on you.
yeah,
Okay.
Thailand and
Yeah.
yeah.
Singapore and everywhere. Okay. So,
Yep.
if you're paying, got a couple more time for a couple more. We're getting a lot of questions. If you are paying quarterly for your business taxes,
Hmm.
how do you file the Schedule C at the end of the year? Do you add those payments to that? I'm assuming that person, who's one of my favorites as well, meant estimated payments. That's
Yes.
that's what I'm assuming. Is that correct?
Yes. You basically as a self-employed person, you're supposed to pay estimated payments on a quarterly basis. Those estimated payments are considered to be similar to if you were an employee and having federal withholding taxes taken out. It's just on a different line item. So you would put the payments on the payments section. And if your liabilities is less than what you paid in, then you would get a refund for what you put in.
Okay. Hmm. We're getting a lot of questions on W-2s and versus business taxes. One is I'll answer the question. You handle both W-2 employees and business taxes. But the reason why
Mhm.
this is so important is that a lot of your clients, a lot of our clients actually have W-2 income, but they also have small businesses. This is the country with a lot of side hustles. And so those
Yes.
hustles are businesses, and now they can receive a lot of the benefits that you discussed today, even though
Hmm.
they have a W-2 income as well.
Yes.
Is that right?
Yes, you can have W-2 income as well as Schedule C income coming in. Um, Keep in mind, like if you receive 1099 income, it gets placed on the Schedule C. You could take deductions from that income. So let's say you had a side business where you're doing consulting and you made $40,000 for the year. Normally, folks would just take that 40,000 and it would just go right towards the bottom line. What we do is we take it and it goes on the Schedule C, and then we look for deductions because it is self-employed, and you'll be able to take any kind of ordinary business expenses, such as telephone and internet charges, and if you have a home office deduction or mileage. Those are the type of deductions that you can have. So that 40,000, we can get it lowered just based on ordinary business deductions.
Okay. The last question is what hold on. Let me make sure. Yeah, okay, here we go. Well, we got
Okay.
a lot more, but this is the last question I'm gonna ask for today.
Mhm.
Um, um, well, hold on. Another part to this. Is there a something that's typically not done, or what would you advise for a um, client to do to really take advantage of all the tax strategies that are available to them? Like, I remember looking at the H&R Block video that talked about how people miss out on billions of dollars
Uh-huh.
of deductions, right? And so we have people who are um, busy. All these folks who are on here today are super busy. The business owners,
Right.
the leaders. Um,
Right. What can they do?
yeah, what can they do to do this? And let me make a point here before you say that. The first thing is to be able to have a conversation. So I'm able to speak. So Sherise is not only my partner, but she's my CPA. So she lets me know what I can spend and what I can't. And but I can also communicate to her in this way where it's comfortable. I can ask these questions and the things that I don't know, and she'll give me the answer. She doesn't talk over my head. She makes sure that I understand those things. I think the communication part is super important. So I just have to
Mhm.
reiterate that. So I think that's the first part. But is there anything you like to add on what would be important,
Yeah.
how people miss out on these deductions?
Yeah. I think it first starts with your tax advisor. And you definitely got to have a good communication type relationship with your advisor. Um, Also, going back to the basics, um, bookkeeping,
Mm,
making sure that you're going through your books. I had a client where she did her books. Books were okay, except we noticed something on her balance sheet, And we were like, well, what's this? And it turned out that she had an invoice that where the work was completed, but the client didn't pay. And I'm like, well, you do know, after a couple of years, this is considered to be a bad debt expense. And the amount was about $60,000.
Mm.
Well, guess what we did? We were able to put that on her 24 tax return. And that's just one transaction. So that one transaction helped save about maybe $5,000 to $6,000 just in taxes, just because of the fact that we reviewed the books. So it's important to make sure that if you have a bookkeeper, um, I would definitely ask questions to make sure that things are going smoothly. If you see something that's out of whack or anything like that. If you don't have a bookkeeper, but you need one, I would strongly suggest getting one, because that's where a lot of issues come into play as far as looking for additional deductions. Even
So,
for
so
the,
Sherise, so you
yeah,
say bookkeeper, you mean someone that's going to look at all the credit card expenses, all the bank account
yes,
expenses, and go through line by line when someone might not be too, like myself, I'm too busy serving
yes,
other people. I don't have time to do that. So get that type of service where someone can do it for them. Is that what you're saying?
yes,
Okay.
yes. It's very important. And sometimes I know our staff, we're very I don't want to say too aggressive, but we ask questions. We want to know exactly if we're looking at transactions, how can this benefit you business wise? How can this be a business deduction? Based on what the IRS has, geared to be an ordinary business expense. So I feel like that is like one of the first things is to have the bookkeeping part, the actual recording of your expenses in check. The other
Okay.
thing is tax planning, 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 planning. Right now, a lot of folks are getting their taxes done, right? But that's for 25. We're working on 26 for clients because 25 is done. So we're working on how we can go and save additional income for this year with all the different changes.
Okay. Thank you. Can you
Yep.
go to the next slide? So we're getting a lot of questions about um, um, calling us and who's a good client for Sherise and all of that. The good thing is if you're on here, just reach out to us. Um, one of the things about Worth is that our goal is to add value. And so if you can't take advantage of any of these things that we're talking about, we're going to let you know that, and your pricing will be accordingly, or you might be in a good situation where you are. Um, and so pricing will range based on what your needs are. The good thing is everything is transparent, so you'll get this information up front. Um, and again, the goal is to add value. So just like Sherise gave the example of the deduction that she was able to take for 60,000, that's value. That's thousands of dollars that's saved. If we can see that, then that's when um, those things will be put in process. But anything else you want to add? Because we got one more minute before we're going to end this, and we want to thank everybody so much for being on this webinar today.
Yeah.
Sherise, anything you want to add?
Um, just that if you are a business owner and if you're looking for ways to lower your tax liability, definitely um, the I would say the tax advisor is so important because the fact that me as a CPA, we have different avenues that we can at least look at to see if there's any kind of different um, ways to help lower your liability. And that is the way that I think. I don't think about refunds. I think about how I can lower your tax liability, and that's what's forefront on um, how we run our tax department here.
Thank you, Sherise. All right, everybody. Thank you. Have a
Yeah.
great rest of your week and weekend. And with everyone who's attended this, you will receive a link so you can have a copy of this presentation. And feel free, any other questions that you have, feel free to reach out to us. Thank you so much. God bless you all.
Thank you.